Revenge trading doesn't feel like revenge, it feels like confidence. That's exactly why it wipes accounts. A trade hits your stop loss, and instead of stepping back, something shifts. The next entry feels sharper, more certain, more justified. It feels like you finally understand what the market is about to do. But that feeling is the trap. Because in that moment, it doesn't feel like chasing. It feels like clarity. It feels like control. It feels like taking back what was just lost. And that's why it's so dangerous. The decision doesn't come from structure. It comes from emotion dressed up as logic. This is where most traders lose control without even realizing it. They don't think they're revenge trading. They think they're correcting a mistake. They think they're getting back on the right side. But what's actually happening is much simpler. They've stopped trading and started reacting. The real problem behind revenge trading is something deeper. It's what I call the lottery mindset. It's the belief that one trade can fix everything. The account is down, frustration starts building, and somewhere in the back of the mind, there's this idea that the next trade is the one that brings it all back. Not slowly, not structurally, instantly. That's not trading. That's a scratch ticket with a chart. And here's the part most people never realize. The market doesn't cape now you lost. It doesn't care. It didn't take your money to give it back. Price moved because large money moved. That's it. No emotion, no intention, no memory of your last trade. But the moment revenge trading starts, the decision is no longer coming from structure. It's not coming from a system. It's not coming from a plan setup. It's coming from a reaction, an emotional response with a buy or sell button attached to it. And that's why these trades almost always feel right before they go wrong. Revenge trading doesn't destroy an account in one trade. It happens in a sequence. The first loss is normal. Risk is controlled, the setup made sense, and the stop loss gets hit. Nothing unusual yet. Then the second trade comes in, slightly bigger size. The logic sounds reasonable. Recover faster, get back to even. It still feels controlled, still feels like trading. But now the emotional pressure is building. By the third trade, the decision is no longer clean. The size increases again. The stop becomes less defined or disappears completely. The thought process shifts from probability to certainty. This has to work. And within a short period of time, a small controlled loss turns into a significant drawdown. What started as a 2% loss becomes 10, 15, sometimes more, all within minutes. But here's the part that makes this cycle even more dangerous. Sometimes that second trade actually wins, and instead of breaking the pattern, it reinforces it. It teaches the worst possible lesson, that emotional trading works. So the next time the same situation happens, the same behavior repeats. Bigger size, faster decisions, less control, until eventually it doesn't work. And that's when the damage is done. Before we go into how to actually fix this, take a second. If you're watching this right after a bad session, you already know exactly what this feels like. The frustration, the urge to get it back, the feeling that you were just one trade away from being right. Drop a comment below and just say, I needed this, I read them all, and if this is something you've been struggling with, make sure you're subscribed because what comes next is not just advice, it's how the right side of the market actually thinks. The traders who stay on the right side of the market all operate from one core principle. Every trade is independent. The last trade does not exist anymore, and the next trade does not exist yet. There is only the current setup, the current moment, and the current structure. That shift changes everything. Because the moment a decision is influenced by what just happened, the process is no longer clean. It becomes reactive. Mark Douglas described this as the probability mindset. I describe it as a discipline with a short memory. A previous loss has zero predictive power over the next trade. None. But the emotional state carried from that loss has a massive impact on the decision that follows. And that's where most traders go wrong. So the rule becomes very simple. If the reason for entering a trade is even partially connected to the previous trade, whether it's to recover a loss, prove something, or correct a mistake, the trade is invalid. Not because of the market, but because of the reason behind it. At that point, it's no longer a setup, it's a reaction. So, what replaces revenge trading is not motivation, it's a protocol. 3 rules, simple but enforced. The first is the 15-minute rule. After any losing trade, there is no interaction with the platform for 15 minutes. No watching price, no analyzing, no just checking. You step away completely. The goal is not to find another trade. The goal is to remove the emotional state before it turns into action. The market will still be there when you come back. The second is the entry check. Before every trade, one question needs to be answered clearly. Why am I entering right now? If any part of that answer is connected to the previous trade, recovering a loss, correcting a mistake, or making something back, the trade is invalid, no discussion. The reason behind the trade matters more than the setup itself. The third is the daily loss limit. A fixed percentage, defined in advance, 2%, 3%, whatever fits the account. Once that limit is reached, the session is over, not paused, not reduced, finished. This rule is not about discipline in good conditions. It's about protecting the account during the worst emotional state. These rules are not suggestions, they are boundaries. And boundaries are what stop emotion from turning into damage. Most traders think revenge trading is a discipline problem. It's not. It's an identity problem. Because the moment a losing trade feels personal, the process is already broken. A loss starts to mean something about you, your ability, your accuracy. But in reality, it means one thing. The market moved, that's all. The traders who last, the ones who stay consistently on the right side, don't focus on being right on every trade. They focus on making good decisions over and over again. A clean, rule-based trade that loses is still a good outcome. A revenge trade that happens to win is not a success. It's a mistake that hasn't punished you yet. That's the difference most people miss. One side of the market is paying for emotion. The other side is getting paid for the structure. And now that you understand what revenge trading actually is and where it really comes from, you're no longer guessing. You're starting to see the difference. And that's the first step to staying on the right side. If this hit home, don't stop here. If you're serious about taking this further, you can join the community using the link in the description. Inside, you'll get access to the full Protocol 369 framework, our indicators, live analysis sessions, and a focused community of traders. Every week, we break down the market and execute with structure, not guessing, consistently generating high probability opportunities for our members. I'll see you on the right side.